Hey James, this is Leonard, the Poker Paparazzi, and actually today I wanted to ask a question regarding home ownership and how that could play into the infinite banking, the wealth building blocks, and potential retirement with the IUL. Basically, there's a couple of trains of thought as to whether or not people want to pay off their homes versus investing or instead of paying off their homes in its entirety, using the available cash on hand for investments, or even to put into a tax deferred instrument like a Roth IRA, or even an IUL per se. Just wanted to get any feedback or any insight that you might have regarding in buying and or investing in a home, whether or not we should do velocity banking and paying off our home, or investing for the future. Thanks a lot, and look forward to hearing your answer soon. Bye.
Okay, I love this question. There's so much that it goes into that it may not seem like it on the surface. So this is going to be a fairly nuanced answer if I can remember it all. If I can remember to answer all the things that went through my head as I was listening to that. But basically, the answer to that question as to whether to use dynamic banking, the answer to whether you use dynamic banking to pay down your house or not, the first thing that I go to when I consider that is, are you in your accumulation phase or are you in your spending phase? Now, if you're in your accumulation phase, this is when I consider we're gathering our assets, we're building our wealth in preparation for retirement, okay? Our spending phase is going to be actually in retirement. And we're going to see a wide variety of passions toward one or the other based on which phase you're in. If you are close to retirement or you're in retirement, having a paid off house is going to mean a lot more to you. You may feel a lot more comfortable not having that payment around. You may feel more comfortable doing traveling or selling, not being tied down. There's a lot of different things that can go into that decision when you get close to retirement. And people tend to shift their attitudes when they get out of the accumulation phase. They tend to shift their attitudes more towards paying down debt and being debt free so that they just have less to worry about. Now, if you're in the accumulation phase, which is where I'm at, and which is, I was thinking about this, it's probably why most of the videos that I do and most of the things that I talk about are kind of in line with still how to get the most accumulation. When I talk to you guys about what I do with my policies, it's from a position of I am smack dab in the middle of my accumulation phase. So for me, I want to have access to cheap money because I'm going to use that to leverage and buy other assets, things that are going to help me in my accumulation, things that are going to accelerate my accumulation. So when I look at home loans, especially right now, home loans are dirt cheap. When they're that cheap, I separate debt from whatever it's tied to. Okay, that's one of the first things that I do. So while I'm in this accumulation phase, my only concern is how cheap is the money that I have access to. Okay, when I bought my quad just a little while back, the credit union offered me cheap access to money that would otherwise be locked up inside that quad as equity. So I'm in my accumulation phase. That cheap money to me is something that says I can put that to better use and earn more than the 4.5% or 4.49% that they charged me for that loan. I can put that to better use. So I just take whatever the loan is, separate it. It doesn't matter if it's for a house, if it's for a car, if it's for a quad, if it's just a line of credit, whatever it is. What is the at it? Because I'm going to put that money to better use. Okay, home loans, super cheap right now. So I'm all over the home loans and not paying them off. If I could get a 3% home loan right now, I'm going to minimum pay that thing for the full 30 years. And what I'm going to do with the excess that I could put towards that is I'm going to put it into my policies first, knowing that I'm going to compound it at least 4%, probably 4 to 6%. I'm going to put it not just in those policies, but I'm going to put them into my IULs, which I'm anticipating a 6 to 8% return that I'm going to get back from those, assuming the stock market performs, right? I'm going to maybe use it to do some more day trading. I mean, I feel a lot more comfortable putting money at risk when it's really, really cheap and knowing that the obligation to pay it back is very, very long. And also that they can't just call on it. So your home loan, the bank can't just call you and demand that you repay it. They used to be able to do that. That was part of the problem back in the Great Depression, right? A lot of the home loans were subject to the whims of the banks. So when the banks struggled, the banks had clauses that they could call a loan due at any time. And that led to a lot of foreclosures back then. Well, it is partly because of that, they changed the laws. You can't do that anymore. It's also because of that you see the Fed not putting banks into that position. The Fed basically makes money available. As in this last recession, they've said they're going to make as much money available as possible, and they've done it to the tune of trillions and trillions of dollars, so that they're not in that position. So we have an asset, we have a home, we can secure it and get cheap money that's due over a long period, and they can't call it due. I love that. Give me all the money I can, and then let me go make better use of it. Okay, so that's my answer to the question. If you're in the accumulation phase, that's how I would view it as well. Okay, now people may feel differently. Not everybody's going to be as comfortable with debt as I am. Okay, so for some people, even if they're in their accumulation phase may entail getting out of debt first. It may, hopefully it's high. Hopefully we're all getting out of high interest debt. First of all, any type of credit card debt, we don't want to have anything over 10% for sure. We typically don't like to see anything over 7%, but some of the lines of credit out there are, 7, 8, 9, 10%. Not much we can do about that except for try to get better lines of credit. Try and secure it with different assets. That's where we're trying to, if I can get a line of credit secured with my life insurance policy and get it at 2% or 3%, that would be awesome. I would probably not really use my home equity line of credit as much unless I had a really good investment that I can do. I mean, if I can get a home equity line of credit at 6%, I'm pretty happy with that. I think I can arbitrage that. But it's going to take more work. It's definitely more work to arbitrage 6% than it is to arbitrage 3% or 2%. So, I think that answered the question. But yeah, it boils down to, for most people, which phase of life are you in? How comfortable are you with debt? And what are you going to do with your savings? So if you're just going to, obviously you don't want to just take that savings and put it in a savings account or put it in a CD, something that's not even going to keep up with inflation. If you're going to do that, you might as well pay down the debt. Okay, but if you're going to use it and you're going to be productive, you want control of more money, not less money. There you go. Okay, so next one. Let's see. Poker says cheap money equals keep money invested instead of paying off the mortgage. Yeah. Yep, basically. And especially like with our life insurance policies, we have with the whole life, we have guaranteed 4%. Now, after the cost, that's gross. So after the cost of insurance, we're going to see, 3 to 6% long-term growth. That's solid. I'm hoping that insurance companies will figure out better ways to streamline their operations in these environments and get those dividends up. right? It just takes some adjusting and figuring out how to do it. But I'm hopeful that they'll be able to do that. And we're not going to be in this really low dividend rate environment for a whole lot longer. We might be, in which case we may end up seeing, closer to a 3% average after the cost of all the insurance is taken into account on some whole life policies. But maybe not. I mean, we're really in this for the long game. And let's see, 30 years ago, the rates were, dividends were up 12, 15%. So 30 years can make a big difference. We have no idea what to expect. I'm hopeful that over the long run, those are gonna pay off. But we have the guarantees, right? Now we also have IULs, which I love for their potential cash growth. Okay, they're not the same type of things that we can do infinite banking with. They don't come with the same guarantees, so we treat them differently. But I do love the potential that there is in them, in the right ones that are designed the right way, of course. And I love that there's a 0% floor. If they gave us the 4% floor like Whole Life did, that would be even better. Guardian does offer an index option, which gives us a 4% floor, but they charge us 2% for using that option. And so, and also the underlying cost of that insurance is based on whole life, not cheaper annual renewable term insurance like the IULs. So recognize that when I talk about the potential in the IULs, there's a greater growth potential, at least in the IULs that I really like when we're going for potential growth. In this case, right now, it's Allianz. The Guardian index option kind of falls right in between that. You take on a little bit more risk because you're going to pay that 2%, but you have that 4% floor. So you end up with essentially a 2% floor. It does give you a greater potential in the long run than just taking the dividends, at least as the dividends are currently projected. So if you want to do something like that within a whole life policy, you have that option with Guardian. Otherwise, IUL for the potential growth, really, really like that option. So yeah, give me cheap money all day long, and I think I'm going to make some good choices here with it.
This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealth Care Wednesday live streams where you can ask the question and we'll answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.